There's a new normal when it comes to oil. With prices still off about 50% from all-time highs, now could be a good time to get in. That's according to Thomas George, portfolio manager of the TD Energy and Resource Funds. Today we look at 3 steps to investing in oil stocks. So step 1 is how you look at the oil price.
Exactly. So we have a foundational thesis on how we look at the oil price, and we believe over the long term, oil prices trend towards that all-in marginal cost of supply, which on this graph is the 95th percentile. And you can see that over the long term, there's a strong relationship between the oil price and this all-in marginal cost of supply. So now there are dislocations over short periods of time, and that's really driven by the inelastic nature of supply and demand. So just by example, if the market is oversupplied, it's very hard for producers to ratchet down production quickly, and at the same time, it's very hard for consumers to consume a barrel quickly. But really at a high level, the way we think about it is the time to be constructive on oil, and vis-a-vis the time to be constructive on oil stocks, is when we are below that all-in marginal cost of supply.
And so where is your outlook or price target right now?
Yes, so for us, we believe that all-in marginal cost of supply and where oil prices will trend is somewhere between $75 to $90 per barrel. We believe that's the new normal in a world with shale oil.
And step 2 is the demand and supply dynamics of oil. What's going on there?
Yeah, so we've established how we should look at oil prices over the long term, but it's very important to look at supply-demand dynamics over the near term to understand how the market will unfold. So what we've really seen is some very constructive data points on both supply and demand. Let me first tackle the supply side. Since October, we've seen the U.S. oil rig count decline by 59%. So that's a meaningful downward trajectory in rigs, and that has had a direct impact on U.S. oil production. So the following chart here shows effectively the growth, month-over-month growth, production growth in each of the 3 key basins in the U.S. So these 3 key basins, the Eagle Ford, the Bakken, and the Permian, have accounted for nearly 90% of all U.S. oil production growth over the last 4 years. Now, what you can clearly see here is that on a month-over-month basis, the Eagle Ford and the Bakken are firmly in decline, and the Permian is effectively flatlining. So from our perspective, we have definitively seen that supply response. Now, let me tackle demand. On the demand side, we've seen rather robust global demand growth. So on a year-to-date basis, we've seen demand growth for end products such as gasoline, jet fuel. So these products are up on a year-over-year basis by 3.6%. Just to frame that into perspective, typical growth for these sorts of end products on a yearly basis is somewhere in the range of 1 to 1.5%. So from our perspective, we've definitely got the seeds for recovery in both the supply side and the demand side.
So step 3 is how you look at the company.
Exactly. So for us, there are 3 key criteria that you look for in a resource company. First, you look for a strong resource position. They need to have good acreage in the best basins. Second, they need to have industry-leading returns on invested capital. And lastly, they need to have low levels of leverage. So just to help understand how that actually works is that we look for companies that effectively don't spend over the cash flow that they earn. So if your effective production basin earns a cash flow, you want a company that's spending in line with that cash flow, because anything over and above that implies that there's a level of leverage that's being involved.
And so that's been happening a lot lately, has it?
Significantly in the U.S. So that's effectively how we got to these high levels of U.S. production. A lot of that was driven by high levels of leverage.
So can you give me an example of a company that fits these 3 steps?
Yeah, so I think one of the clearest examples that really checks each one of these 3 boxes is EOG Resources. It's one of the highest quality exploration and production companies in the U.S., period. So first and foremost, EOG has the best acreage in the U.S. in each of the 3 key growth basins. So the Eagle Ford, the Bakken, and the Permian. So that's critical. They've got the best acreage. Second, EOG has the best returns on invested capital amongst all its U.S. E&P peers, so amongst its U.S. exploration and production peers. And lastly, it has the lowest quartile of leverage amongst its peer group as well. So this is a company that checks all three key boxes.
So are there any risks to that company?
From our perspective, there's risks to all resource companies, and it's really driven by commodity. But from our perspective, the way we think about commodity companies, we look for risk-adverse commodity companies, and specifically EOG really embodies that. They will only produce a barrel if it meets their return on invested capital threshold.
All right, thank you very much, Thomas.
Thank you.
I've been joined by Thomas George, Portfolio Manager of the TD Energy and Resource Funds. Thanks for watching.